Hi, welcome to my YouTube channel, My Solution. I'm Raul. In this video, I will be discussing all about receivables. Receivables are financial assets that represent a contractual right to receive cash or another financial asset from another entity. For retailers or manufacturers, receivables are classified into trade receivables and non-trade receivables, while banks and other financial institutions receivables are classified mainly as loan receivables. Going back to trade receivables, this refers to claims arising from sale of merchandise or services in the ordinary course of business. Trade receivables includes accounts receivable and notes receivable. Accounts receivable are open accounts or those not supported by promissory note. Sometimes it's called customers accounts, trade debtors, or trade accounts receivable. While notes receivable are those supported by formal promises to pay in the form of notes. I will explain more on notes receivable in the next video. So be sure to subscribe to my YouTube channel to watch on my upcoming videos. If trade receivables arises from ordinary course of business, non-trade receivables on the other hand represents claims arising from sources other than the sale of merchandise or services in the ordinary course of business. Few examples of non-trade receivables are as follows: advances to shareholder, directors, officers, or employees, advances to affiliates, special deposits on contract, accrued income such as dividends receivable, accrued rent income, accrued royalties, and accrued interest on bond investment. Claims receivable such as claim against common carriers against losses or damages, and many more. So how do we classify and present trade and non-trade receivables in the statement of financial position? Trade receivables which are expected to be realized in cash within the normal operating cycle or 1 year, whichever is longer, are classified as current asset, while non-trade receivables which are expected to be realized in cash within 1 year, the length of the operating cycle notwithstanding, are classified as current asset. Trade and non-trade receivables which are currently collectible shall be presented on the face of the statement of financial position as one line item under the current asset. As mentioned earlier, this video is for accounts receivable, while notes and loans receivable will be discussed separately in my future videos. So as I have said, accounts receivable are open accounts arising from sale of merchandise or services in the ordinary course of business, initially measured at face value or original invoice price. However, this should be subsequently measured at NRV, or net realizable value. NRV means that the amount of cash expected to be collected or estimated recoverable amount. Accordingly, in estimating the NRV, the following are to be deducted from the accounts receivable. First is the allowance for freight charge. Next is the allowance for sales return. And the third is the allowance for sales discount. And fourth is the allowance for doubtful accounts. We will discuss this deduction one by one for you to appreciate more on what we are talking here. We start with the allowance for freight charge. For you to understand freight charge, you should familiar with the term FOB destination, FOB shipping point, freight collect, and freight prepaid. FOB destination means that the ownership of goods purchased from shipping to the destination is on seller. Ownership will be transferred only to buyer upon receipt of goods. Therefore, since the seller is the owner of goods during shipment, it is incumbent upon the seller to pay for the freight costs. FOB shipping point, on the other hand, means that the ownership of the goods purchased is vested in the buyer upon shipment. Therefore, the freight cost should be shouldered by the buyer. Freight collect means that the cost of freight for the goods shipped is not yet paid. The carrier company shall collect the same from the buyer. Therefore, the freight is actually paid by the buyer. While freight prepaid means the freight cost on goods shipped is already paid by the seller. So for you to understand more on what I'm trying to explain, let me give you an example. An entity made sales on account amounting to 50,000. The terms are 2/10 and 30. FOB destination and freight collect. The customer paid freight charge of 2,500. So in this example, sometimes goods are sold FOB destination but shipped freight collect, with the understanding that the buyer will pay for the freight charge and deduct the same when the buyer paid the seller. On the part of the seller, the freight charge is recorded by debiting freight out and crediting to allowance for freight charge. Let me show you the pertinent entries for this example. So to record the sale, you have to debit the accounts receivable 50,000, debit freight out 2,500. Freight out is actually an expense on the part of the seller. So we will credit sales, of course, 50,000, and credit for the allowance for freight charge 2,500. Okay, when the customer paid the seller, so to record that, so we have to debit cash amounting to 46,500, debit sales discount 1,000. That is assuming if the customer paid within the discount period. So you just have to multiply the 2% to 50,000. So you should have to get 1,000. So where are we now? So we have to debit also the allowance for freight charge 2,500 and credit to accounts receivable amounting to 50,000. Next allowance deducted at accounts receivable is the allowance for sales return. When a company made a sales on account, there is a probability that some customer will return goods that are unsatisfactory or with defects. In this case, the amount of receivable will reduce equal to the amount claimed. For example, Company X sold goods to various customers amounting to 100,000 all on account. Previous experience shows that 2% of the goods sold will probably be returned. So based on the example, the journal entry to record the sale and the recognition of probable return as follows. So to record the sales, you have to debit accounts receivable 100,000 and credit sales of 100,000. So you to recognize the 2% sales return, so you have to debit sales returns 2,000 and credit allowance for sales returns 2,000. The next is allowance for sales discount. Normally, companies offers cash discount to credit customer from an invoice price to attract customer to pay early. A cash discount may be expressed as 5/15 and over 30. This means that the customer is entitled to a 5% discount if payment is made within 15 days from the invoice date. So if customers are granted cash discount for prompt payment, then companies should estimate cash discount on open account at the end of the period based on their past experience. For example, a company accounts receivable year-end balance showing the amount of 50,000. Based on experience, it is estimated that 5% discounts will be taken. So to recognize that the expected sales discount, the company should record debit to sales discount 2,500 and credit to allowance for sales discount 2,500. Note that adjustment may be reversed at the beginning of the next period in order that discounts can then be charged normally to sales discount amount. And finally, the last allowance deducted to accounts receivable is the allowance for bad debts, which is the most famous among the four allowances. When companies sell on credit rather than cash to increase their sales, that company also assumes that the risk that some customer will not pay their accounts. So when an account becomes uncollectible, this becomes expense to the company, and this loss is simply one of the costs of doing business on credit. There are two methods followed in accounting for this bad debt, namely the direct write-off and allowance method. Direct write-off method requires recognition of bad debt loss only when the accounts prove to be uncollectible. So, if for example, if there is a probability for one account not to pay, there will be no accounting entry to be made until there is an evidence that the company indeed cannot pay their account. Unlike in allowance method, the company estimates bad debts expense when the loss is probable and the amount can be estimated reliably. There are three methods in estimating bad debts under allowance method. These are: the first is the aging, the accounts receivable, or the statement of financial position approach. The second is the percentage of accounts receivable, also the statement of financial position approach. And the last is the percent of sales or income statement approach. To illustrate the three methods, let us try to solve the problem as follows. Jack Company provided the following information in relation to accounts receivable on December 31, 2019 for its first year of operation. So the data given here is the aging, days outstanding, estimated amount, uncollectible percentage. So days outstanding 0 to 60 days, there's 1.1 million. Percentage of uncollectibility is 1%. 61 to 120 days, 500,000. Uncollectibility is 2%. Then over 121 days, 400,000. Uncollectibility is 5%. And the total accounts receivable is 2 million. Sales registered amounting to 5 million. Cost of sales 1.5 million. And general and administrative expenses registered to 1.2 million. So what is the requirement? The first requirement is using the aging of accounts receivable. How much is the balance for the allowance for bad debts? Second requirement, assuming Jack Company estimates its bad debts for 2% of its net accounts receivable balance. Compute for the bad debt expense on December 31, 2019. Last requirement, assuming Jack's company estimate its bad debts based on 1.5% of its sales, how much is the bad debts expense on December 31, 2019? Solving the first requirement, using the aging of accounts receivable, we just have to simply multiply the estimated amount by the percentage of uncollectibility. So 0 to 60% days, The amount is 1.1 million. We just have to multiply 1%. So we will get 10,000. Then 61 to 120 days for 500,000. Multiply by 2%. So that's 10,000 also. And lastly, over 121 days, which is 400,000 multiplied by 5%. So that's 20,000. So if we're going to total it, 10,000 plus 10,000 plus 20,000, that's totaling to 40,000. Since this is the first year of operation and no other information was provided, we can safely say that 40,000 is the balance of allowance for bad debts. The pertinent entry for this transaction is to debit bad debt expense 40,000 and credit to allowance for bad debts 40,000. Moving to the next requirement, assuming Jack Company estimate its bad debts for 2% of its accounts receivable balance, so compute for the bad debt expense. As shown in the problem, accounts receivable balance was 2 million. So we just have to multiply 2%, so we can get 40,000. When using the percent of accounts receivable, 40,000 is actually the required allowance. So if there is a balance of allowance for bad debts in Jack's company, we should deduct that amount to 40,000 and the difference should be the bad debt expense. And since this is the first year of operation, 40,000 will also be the bad debt expense to be recorded in the books of account. The pertinent entry is the same as that of the first method. To recap the first and second requirement, if you notice that both of them uses the accounts receivable or what we call the financial position approach, when this method is used in estimating the bad debt expense, then the resulting figure will be the required allowance, meaning the allowance for bad debts ending, the figure that should be shown in the balance sheet. So the last requirement, assuming Jack's company estimates its bad debt of 1.5 based on sales, we simply multiply 1.5 to the sales amounting to 5 million, so we get 75,000. The amount arrived in multiplying rate to sales is already the bad debt expense. When the percent of sales method is used in computing bad debts, proper matching of costs against revenue is achieved. This is because the bad debt expense is directly related to sales and reported in the year of sales. The main argument against this method is that the accounts receivable may not be shown at estimated realizable value because the allowance for bad debts may prove excessive or inadequate. Therefore, it is necessary from time to time that accounts should be aged to ascertain the probable loss. So that's all for accounts receivable. In my next video, we will cover notes receivable and loans receivable. Okay, if you think my video is helpful, please don't forget to comment. Thank you for watching my video. Don't forget to like and subscribe.